A and B are partners in the ratio of 1:1. The balance sheet appears as given here. We are required to show revaluation account, partners capital account and the balance sheet. Now students, in this case, have a closer look at the balance sheet. We are given general reserve. There is no goodwill on the asset side. Plus the additional information is that C is admitted as a partner. He brings 1 lakh as his capital and 60,000 as his goodwill. That means he is bringing his share of goodwill in cash. Building is to be revalued at 2,10,000 and creditors are to be valued at 20,000. So now students, let us start with revaluation account first. The building originally appears at 1 lakh. It is to be revalued at 2,10,000. That means there has to be an increase in the value to the extent of 1,10,000. So by building 1,10,000. Then coming to creditors, creditors are appearing at 30,000 but they should be valued at 20,000. That means again there is a decrease of 10,000. This decrease again should be represented on the credit side as by creditors, as it represents the profit to the business. So 10,000 on the credit side, the total comes to 1,20,000. This 1,20,000 is the profit on revaluation and should be transferred to partners capital account, that is profit, in their old ratio, right? So old ratio means to the old partners who are A and B here, that is 1,20,000 in their ratio of 1:1. So individually they would be given 60,000 each. 1,20,000. Now students, remember you must always make sure that the journal entries are presented somewhere. So for this case, journal entry would be building to revaluation. Since the value of asset is increasing, since the value of creditors is decreasing, and when the liability is decreased, entry is liability to revaluation. So in this case, it would be creditors to revaluation. Now let us move ahead and prepare partners capital account. But remember, while preparing partners capital account, we will have to take into consideration the capital and the goodwill brought in by new partner. This is how the format of capital accounts will appear. Individually for A, B and C, 3 capital accounts will be prepared. These 2 capital accounts represent the account of old partners and C is the new incoming partner. Again, particulars and amount on debit side and on the credit side as well. Now students, A had a balance of 1,20,000 represented in the last balance sheet. So by balance brought down on the credit side 1,20,000 and for B it was 1 lakh. Now we had prepared revaluation account. In revaluation account, there was a total profit of 1,20,000 which was divided among A and B in their profit sharing ratio, which was equal. So 60,000 was given to A and 60,000 to B, which will be represented as by revaluation account profit 60,000 for A and 60,000 for B by revaluation both in A and B. Now students, C has brought in certain amount of capital, that is 1 lakh, and 60,000 as his premium. Since he is bringing 1 lakh as capital, that will appear as by cash in C's account 1 lakh, and the 60,000 that he has brought in for his premium would be provided or would be divided among old partners in their sacrificing ratio. Since in this question new ratio is not given, nothing is mentioned about sacrifice, so old ratio, that is 1:1, would be taken as sacrificing ratio. So the entries would be by premium 30,000 to A and by premium 30,000 to B. The balance sheet also had 50,000 on account of general reserve. Now students, this general reserve represents accumulated profits of previous years which must be divided among old partners before the new partner is admitted into the business. So by general reserve, 50,000 would be divided among old partners in their old ratio, that is 1:1. So 25,000 for A and by general reserve 25,000 for B. Now all the entries have been posted. Let us total it out and find the balances. For A students, the balance comes to 2,35,000. That is 1,20,000 plus 60, 180 plus 30, 2,10,000 plus 25,000 is 2,35,000, and it will be written as to balance carried down 2,35,000. Remember, this is the amount that will now appear in the new balance sheet, that is the balance sheet of A, B and C together. Coming to B's account, the total of B's account is 1,90,000 plus 25,000 is 2,15,000, and this will be written as to balance carried down 2,15,000. Again students, while preparing the new balance sheet or the balance sheet of the new firm, B's capital account will show a balance of 2,15,000. For C, there is only one entry, 1 lakh, and the balance carried down would be 1 lakh. Now students, we have prepared revaluation account and capital accounts of the partners. We have calculated their closing capitals, 2,35,000 for A, for B it is 2,50,000, and since C is a new partner, his capital is 1 lakh. These are the capitals that will now be appearing in your new balance sheet. Let us see how that balance sheet would be prepared. But remember, while preparing that balance sheet, you will have to take into account these new balances. There will be new balance for cash, that is including the cash brought in by C, as well as revalued values of assets and liabilities will appear in that balance sheet. Coming to the balance sheet of the new firm, that is balance sheet of A, B and C as on liabilities and assets. So now students, starting with liability side, the first entry was creditors. But remember, creditors were revalued at 20,000. 10,000 must be reduced now. So 30,000 was there in the earlier balance sheet, minus 10,000, it will be shown as 20,000. Then capital accounts for A, B and C. A's capital was 2,35,000 as we had calculated. B's capital was 2,15,000 and C had brought in 1 lakh as his capital. Now students, there was general reserve in the opening balance sheet or the balance sheet of A and B. That will not appear here because that has already been adjusted into the accounts of old partners. Also remember one thing, in case of revaluation, there might be certain new liabilities. So you must be aware and you must take precaution that in case there are new liabilities, they have to be shown on the liability side. The first entry on the asset side was cash. Now students, the cash originally appearing in the balance sheet was 50,000 and C has brought in 1 lakh as his capital and 60,000 for premium. That means C is bringing in total cash of 1,60,000. So the cash balance would be 50,000 plus 1,60,000 brought in by C. That is total of 2,10,000. Next there was stock. There is no change in the value of stock, so it will appear at 30,000 and will continue to appear at 30,000 only. Then we have building. The value of building was appreciated and it now stands at 2,10,000. Land. There was no change in the value of land and hence would continue to appear at 1,20,000. Remember students, any change on account of revaluation of assets and liabilities is not shown by way of addition or subtraction. It is directly included in the value of assets or liabilities. It is not depreciation that it should be deducted. It is actually adjustment according to market prices. So you have to write it directly. Now let us total out the balance sheet and it should tally out. That would mean that we have made all the adjustments correctly. This is 3,30,000, 3,60,000 and 5,70,000 total on the asset side. On the liability side, we will have 4,50,000, 5,50,000 plus 20, that is 5,70,000, which actually tallies out your balance sheet.